And today we are going to be covering the third part of this workshop series, how to use your balance sheet and cash flow statement. This is an experiment that we've been doing, a different type of way to engage with you. So let's talk about what we're going to cover today. I am Stephen Brown. I am your instructor. I'm also the COO and co-owner at LedgerGurus. I also am a CFO with some of our customers. I also co-own Sole Toscana, a direct-to-consumer Italian organic skincare. I bring that up because we are going to be using data from Sole Toscana. I have a bachelor's in engineering and an MBA, and been in LedgerGurus for 10 years, and we've owned Sole for over 2 years. All right. Like I said, this is part 3 of our workshop series. If you were not able to attend part 1 or 2, they are available on demand, and Kelly can drop you the link to where you can go to see those workshops. The idea of this workshop is how to help you better understand your financial statements. And part 1 was basically an understanding of accrual accounting for those who needed a little refresher or some education. Part 2, which we did a few weeks ago, was on how to use your profit and loss statement. And today we're going to talk about the balance sheet and cash flow statements. Obviously, we're LedgerGurus. We help with a lot of different aspects of accounting for consumer products businesses, everything from monthly accounting, bills, payroll, inventory accounting, sales tax. I work on more of the bullets on the bottom. And so if you want to nerd out with me, I'm the person you can talk to. Just reach out and you can connect with us and we can see if there's some way we can help you. For those of you that are current customers, love to have you here. Hopeful to help you get a better understanding of the things that we're producing for you. All right, the goals for today's workshop. Understand balance sheet concepts, analyze your financial health, interpret a cash flow statement, learn how to use QuickBooks more effectively. And I'm going to show you as we go how visualizing this data is more interesting. This is something we're getting to roll out to our current customers who are doing monthly accounting with us. And I'm going to show you visualized versions of this data. This is going to be a hands-on activity. So if you have QuickBooks Online, you can use it. If you're on a different accounting software, obviously the reports are different, but the concepts are the same. So if you want to run your reports from your business side by side and have a second screen, please do. When we go in, I'll show you how I run some of these reports. All right, Kelly, why don't you close the current poll and just launch the other one. We'll run this second poll for a minute. And basically, I want to know how comfortable you are reading a balance sheet and a cash flow statement. I'm going to ask you the same question at the end of the workshop. And hopefully, we've made some progress in your understanding. One would be, what's a balance sheet? Barely know anything. 10, you're a pro, time to promote you to a CFO, or maybe you are a CFO. In which case I would say, maybe you should be teaching this with me. But if you just are here and you're a pro, well, I appreciate you joining us. All right. Like I said, we're going to be using real data from a brand that I co-own called Sole Toscana. We bought this 2.5 years ago. It is Italian organic skincare. And part of the reason that my business partner at LedgerGurus and I decided to buy a brand with a third partner is we wanted to have a laboratory, so to speak, to better understand how our customers are going about their business. And so I have some real data that I'm going to show you from that business. So it'll be a lot more interesting. Okay, I talked last month. If you joined me last month, I talked a little bit about my continuous financial performance process. And that's where we would take our profit and loss, we would analyze it, we would use that to do budgeting, and then we used operational analytics to make decisions. So on the top one, we'd say, how did the business do versus budget and validating our operational analytics. We are making projections against a business plan, and we are measuring daily activities. So we use an analytics tool in that case. to make decisions. I have a similar process that really deals with cash and inventory, which are the two key things on the balance sheet that we're dealing with the most. Um, and actually your payables and loans. So I'm analyzing my balance sheet and statement of cash flow. I'm forecasting, um, and we're making operational decisions. So usually when we're analyzing, we're trying to figure out what our resources are. Where did my cash go? On the forecast, we're particularly looking at cash balances and usage and inventory purchases. Those are the key things. Also, with the cash usage, that gets into debt and to other things. And then operational decisions, me and my operational partner, at Sole Toscana, or if I'm doing this with other customers, we're really usually making a couple of decisions. Key decisions is how much inventory do we buy and when, and how do I fund purchases or paybacks. So let's talk about how we do this analysis. There's a very simple equation. You learn this in like accounting 101. Assets equal liabilities plus equity. So it's called a balance sheet because you'll see the total amounts of assets will equal the total amount of liabilities and equity. It has to. Let's talk about what are in each one of these components. And I'm going to talk specifically about a consumer products business. Different business industries might measure things slightly differently, but there'll some things that are universal. For example, every business is going to measure cash or the bank accounts. And in the case of a consumer products business, you're also going to be looking at holding accounts such as PayPal, Shopify, Amazon, because they hold cash. One of the things that's always fun is when we get a new customer, we go and we find, oh, you got all this cash that's parked in there that hasn't been deposited. And it can just happen. Accounts receivable is less common in a consumer products business, but if you're selling to retail or wholesale partners, you're more likely invoicing them and potentially have accounts receivable. Obviously, one of the biggest things, in fact, one of the biggest things on an asset part of the balance sheet is inventory. Ideally, it's just the perfect size, Goldilocks, easier said than done. Sometimes if you're buying things in advance, a good example would be like annual software subscriptions. You might be tracking those as prepaid expenses that you want to expense onto the profit and loss over time. I will refer to some of these concepts that are in workshop 1, but I'm not going to go into them. You may have fixed assets. Those are things like a building, a forklift, etc. And there are other things known as intangible assets like goodwill, or let's say you bought a trademark, you bought a domain name. Those are kind of intangible assets because you can't really hold them, but you can buy them. So let's just take a look real quick. I was gonna do this after we go through each section, but I think I'm gonna do it a little differently. Let's look at each section side by side. And this is a good point where you could go into your QuickBooks Online and do the same thing. So I am going to run the balance sheet report by going to balance sheet. If this is not one of your favorites, it should be. Okay, so I've got my balance sheet here. The key things of the balance sheet is you're looking at it over a time period. I'm looking at August because we haven't quite wrapped up our September. So this one is a closed period. And so you'll see here some of the concepts that I talked about. At the very top is my assets, and I've got all my bank accounts. Now, this is one of my favorite assets because this is essentially your cash. And you'll see that we have a bunch of bank accounts because we do profit first. So we do that little game. And for people that do profit first, they may have a few more bank accounts. But then we also have these holding accounts, which I love to see them being very low. It means that we've pulled cash. Got my PayPal holding account. We pull cash out of that twice a week. And Shopify, just depending, that on the payout schedule, there can be a decent amount of cash in there. We don't have any AR. We do occasionally do some AR being accounts receivable. We occasionally do invoicing, but not very often. We have some other assets. So the big one I mentioned is my inventory. I kind of wish that QuickBooks didn't treat inventory as another asset because for a consumer products business, you can see that I have a lot of inventory because this is the time of year we're ramping up for the holiday season. So I'm pushing a lot of cash into inventory. Um, and then I want to talk about one of these goofy other assets, the intangibles that QuickBooks calls an other asset, goodwill. Why do I have goodwill? Well, when you buy a business, you pay a price. There are things that are valued, the assets. So we bought a certain amount of inventory. In this case, it was a very simple business. And the rest of the value shows up as goodwill. So you'll see that we have this goodwill asset that we have been depreciating. It's a lovely little tax technique that makes my cash flowing business otherwise show a loss because I am using tax treatment to expense goodwill. So those are my assets, and then those get added up. The ones that I love that I look at very closely with my businesses and my customers are my bank accounts and my inventory. I look at those very regularly. The others I look at less regularly. Okay, so that is your asset portion. Obviously, if you have questions, shoot them my way. We're going to go to the next section. Okay. Then you get into your liabilities. So the most common liabilities you see in a consumer products business, and some of these are in every business, accounts payable, aka the bills, credit cards. So when you're doing transactions, those are usually building up a liability. I've got to pay off that credit card. One that we see that we do a lot of is gift cards. Most consumer product businesses sell gift cards. Gift cards are actually a liability. Until they are redeemed, they are unearned revenue. This is a concept that you'll see in a lot of businesses. So, and some businesses will have this huge amount of gift cards, and sometimes there's different treatment for when you should, you get really old gift cards. Can I apply them as revenue? But essentially, I receive the cash as an asset and a liability of a gift card in the form of unearned revenue. So that's a funky accounting concept when you see. Um, Mark asked me a question about. I'll come back to that, Mark. Let me go back to the QuickBooks and I'll show you that. Loans, short and long term, and then sales tax collected. And I'm actually gonna bounce. I had this later, but I want to show you this. I've shown this in the last two screens. Do not believe Shopify. Shopify does not understand accounting. So when they show you this as total sales, it's a lie. And we talked about this in workshop one. Your actual income would be your net sales plus your shipping income, which they do not. Oops, sorry, it's going a little wonky. What you see here with taxes, that money that you collect actually goes, sorry, my PowerPoint's going crazy. That actually goes onto your balance sheet, not um, onto your profit and loss. And so that would go, the cash collected from taxes would go into your bank accounts, and you would also have a liability for tax owed. So this is something that gets into the liabilities section. And as I said, like with double entry accounting, there's always two entries. So when you get some cash, some of the, in the case of a balance sheet, some of it goes to asset, and there's usually in this case, there's something in the liabilities as well. So let's go back to our balance sheet and talk about this. Mark asked me a good question. I want to answer that. He was like, what is this Relay sales tax? So Relay is the bank that we're using for this business. It's a nice bank. We can recommend it. Also like Mercury, also an awesome bank. Basically what I do is we put aside the money that we've collected for sales tax into a dedicated account. So we don't mess with that. I also do the same thing for income tax. Highly recommend that as a technique. That's Profit First has made those things popular. I did some of those techniques before I read Profit First, and essentially it's like this is money we don't get to spend on the business. It's reserved for specific purposes. So if that looks a little bit confusing, all that is a dedicated bank account to sales tax, and we also have a dedicated bank account income tax. You'll also see that we have a dedicated bank account for inventory and fulfillment. So we allocate a percentage of sales for inventory and fulfillment purchases. Well, let's go down to our liabilities. So we see we have our accounts payable. We have our credit card from this time period. And then we have some loans. Where are my loans at? Oh, these are current. Okay, so we use American Express. We've got a line of credit, and then we lent the business some money early on. We could have done it as a capital investment, but we decided to do that as a loan. And then our sales tax liability. So you can see that we have applied, this is what we owe in sales tax that we need to pay out. Oh, and I have one other line of credit. So I've got a couple lines of credit on this business. So that's this business's liabilities section. Every business is going to be a little bit different, but a consumer products business will typically have those types of accounts, sometimes a few more. And then the last part is your equity. So that's the investment into the business, the money I put in. So we actually put money in as debt. We said, hey, we want to get paid back this money. We don't actually want to wait till we sell the business to get the money paid back. So you'll get your owner's investments. There's also a section called retained earnings. So if you have profits and you roll them into the business, you keep them in the business. Those are known as retained earnings. If you are doing stock and some of those things for corporations, you also have a section for that. This business is really simple. We bought it in cash, woot woot. And so we just have some we call them partner contributions. We have some retained earnings. You can see that that's negative, means we have not created profits in the life of this business, although we have been profitable recently, but we had to, thus the loans. And over this time period, our net income will also get reflected in there until you apply that as retained earnings through this time period. Like so many consumer products, we are around a break-even business. All right. So those are the fundamentals of a balance sheet. Now, what am I looking at when I'm looking at my balance sheet, right? There's a couple things that I can look at. I can look at prior periods. So I like to see, changes in balances. Do I have more or less cash in the same period? And yes, I have more cash. Do I have more or less debt? So those are some of the things that I like to look at. The best way I like to look at that is I like to visualize that. Hui is asking me a question about partner contributions. That's basically the money that I put into the business. The business partner contributions, Hui. So when you saw that down here, that's the money we had to put into the business to buy it. Owner capital accounts. I'm not 100%. So Mark asked me a question. How do owner capital accounts work? I didn't notice that you had any. So sometimes these are named differently. Right now we haven't taken any money out of the business. So capital in, partner contributions, owner equity, sometimes that's all the same. And I'm assuming, Mark, when you're talking about owner capital, I'm assuming that's money in. As we start to do distributions, we could have a separate account that would show that we have taken money out of the business, which we have not in this case. It's a new business, still driving the profitability up. So oftentimes what you'll see for these accounts is they'll be named differently, which is why it might be confusing. Your particular chart of accounts may have one name, but it's kind of the same concept. It's the money that you as an owner put into the business. All right, what I was going to say is the numbers are nice, but I love visualizing the numbers. So this is something that we're starting to do with our customers. which is visualizing balances. So, you know, for me, it's a lot easier to see, okay, what happened, right? We had, and what I need to do add to this is, as we've been doing more debt, is a debt balance. But I can see how I've been doing my inventory. Um, we've been purchasing more inventory. We've had more sales, so that's probably something to look at. Hey, is my inventory growing faster than my sales? If so, why? There's a variety of reasons why it might grow faster than sales. But it's a good, if I see, hey, I have more inventory this time versus that time, why did this big jump up? Well, that was the holiday order, right? And then we sold a lot of inventory, and you could see our balances went lower. Um, that's not atypical for a consumer products brand, is you're going to see a lot of inventory. So my cash goes down, my inventory goes up. Maybe my cash stays somewhat level because I've got debt. I need to put a debt metric in here as well so I can kind of keep track of that. Um, so I like visualizing the data. Can I do this in QuickBooks? Sort of. It's not great, which is why we're starting to build this for our customers. So QuickBooks does have this thing called the Performance Center. I think from previous workshops, people were like, you don't see it. It's only available for accountants. So accountants, we can generate some of these reports. I'm underwhelmed is how I would describe my feelings about this. Um, the options are limited, and how I present that data is also limited. Uh, we have decided to use a more interesting tool, a business an intelligence tool, analytics tool. There's a lot of third-party reporting tools to create a very specific view of that data. But the reason I like to visualize that data is it's just a lot easier to interpret it quickly versus if I have to like look at, and I can kind of see a story here. I can see like inventory is really low and then it went up. Why? Well, because we're ramping up for holiday sales. And you see a parallel in cash. So cash gets really big and then it starts to go down because we're paying down debt. We quickly pay down a lot of our loans as we have those huge holiday ramp ups, and then we get down to a level set of cash, and then we're back in that game. So I prefer visualizing all financial data, but I still use the reports. So if I want to drill into a report and understand what's going on, like I can see my total bank balance, but if I want to see, where is my cash? Do I have any cash in holding accounts? Is it building up in holding accounts? Am I tracking holding accounts? I have not, I would say it is not uncommon that we'll go into a customer in the process of getting access to the information, and we'll find, oh, you have this huge balance in your PayPal account or your Amazon Pay account, right? And because you don't have auto deposit turned on. We had an issue recently. We inherited the PayPal. We basically took over the PayPal account from the previous owner, and we um but we were having issues getting the ownership information transferred to us. So we just decided to say, forget it, we're gonna spin up a new PayPal account. We hadn't closed the old account, but we had moved all of the money flow to that new account. And then out of nowhere, we had a bunch of deposits. We still haven't been able to figure out what's going on, but in the process of doing our accounting, the accountant said, you got a bunch of money, there's something wrong here. You got money in this account, or it was in the process of closing it out. They said, hey, something's up. We went in, sure enough, there was money in that old account. And so we were able to pull the cash out. Couldn't quite figure out why cash had flown into that account. And to this day, we're still like scratching our head. And until we figure that out, we're like a little bit nervous shutting down that account. But this is the complexity of an e-commerce business, is you have all these payment methods and accounts, and money can go in a lot of places. So drilling into the data is still super useful. I can see the big picture visualized, but usually at some point I want to drill in. I want to see where's the balances. I want to see, what's going on across the balance sheet. All right. So that is the basics of a balance sheet. Now I want to move on to more of an advanced concept using this data. Looking at balance levels is helpful. It's useful. You should totally do it. But the real power of a balance sheet is what you can do in some key measurements. So there's some critical ratios and KPIs that give you really interesting insights, and I'll show you them. They are hard. You have to calculate these, which is anywhere from a little bit of work to a lot of work. Let me talk about some of my favorite balance sheet ratios. There's two in particular, but I have to talk about one to talk about the other one. There's the current ratio, but my favorite is the quick ratio for consumer products businesses. And then there's the debt to asset ratio. The current ratio shows the ability to cover short-term liabilities with short-term assets. So if I had to pay all of my bills and credit cards, do I have enough cash to do that? The one I like even better though is the quick ratio, because the quick ratio will exclude inventory in this calculation. And I like this because, no offense to all of y'all and myself, our inventory is hard. I can't pay bills with inventory. So I like to look at the quick ratio, and that's a little bit more of a brutal measurement. And the other one I like to look at is debt to assets. So what percentage of assets are financed by debt? Now let me show you how I calculate these. The current ratio is basically you take all of your current assets divided by your current liabilities. And in general, 1.5 to 2 is considered good for e-commerce. You can be below 1 and be fine. And I'll show you in the case of our business what below 1 means. But it just means you're at more risk. If you exclude that inventory, 1 to 1.5 is considered good. Again, you don't have to be at this level, but these are kind of good targets. Your debt to asset, is basically you're taking your total liabilities divided by your total assets. And so it's basically how leveraged are you against your assets, and 0.4 to 0.6 is considered good. Let me talk about those, and then I'm going to come into this one because this one's a little bit gnarly. So these QuickBooks doesn't calculate these for you. They do, again, the underwhelming performance setter, which your accountants have access to, can give you the quick ratio and current ratio, except for some reason I went into it today and it's not there. So again, it's like, that's cute, QuickBooks, keep trying. So you can go in and run these calculations, or you can use a reporting tool like I have here. And here's my quick ratio. Now, before you panic and say, uh-oh, you're in trouble, a lot of this is due to loans personal loans to the business. So it's kind of all our money. We have this is a significant amount of this is a reflection of loans that we made in the first year to the business that we're still paying back. Probably should have made those long-term loans. They were intended to be short-term loans. They've ended up being much more long-term. We haven't moved them to long-term liabilities. So don't hate me. But that's why I have a below 1 quick ratio. And but the business is still running because, like I said, what we're doing is we're deferring paybacks in this case. Debbie, thank you for your comment. This webinar is going to be recorded, so you're welcome to watch the recording for the rest of it. Okay, so that is one indication of this is a quick ratio, and it doesn't look pretty. Likewise, I actually had to do, I have asset to debt, but because we bought the business, my ratios are all messed up. And my tangible asset, so I basically did tangible asset to debt ratio, excluding the goodwill. Because goodwill is this squishy, it's a whole different thing that I talked about earlier. And it's a little bit high, right? We have 0.4 to 0.6 is usually what you want to be at. You can see that this year we've been rocking around 0.8. We're slowly paying back those loans as personal loans get paid back. That should go down, and then we'll get into a good range. So again, because of our own little the way we're lending to ourselves, it looks worse than it is. Basically, what it says is I'm not paying back my personal exposure is my personal investments in the form of loans have created a less than ideal outcome from a performance management. But you can see we have brought down that tangible asset to debt ratio over time. And our plan is to continue to drive it down. Okay. So again, you can calculate these by hand every month, or you can use a reporting tool and see these over time. And what they kind of tell me is how much leverage am I getting and how much liquidity do I have? Liquidity being how easy would it be for me to pay bills if I had to pay bills? And in the case of this particular business, it's not great, but a lot of that is the exposure of personal loans that we're treating as short-term liabilities. Okay, let me talk to you about there are certain metrics that are a combination of, let's see, where to go? They're a combination, I should have rephrased this. They're a combination of data on your profit and loss with your balance sheet. And my very favorite one, there's a number that you can do, and I'll show you a list of some of the other ones, but this is my very favorite, and it is gnarly to calculate. In fact, I did it in MBA school, and I thought I never want to do this again. And then I did it again. There's this concept of the cash conversion cycle that measures how long it takes to convert investments in inventory into cash flow from sales. And that is made up of three components. There's a component called days inventory outstanding, which is how long inventory is held before it's sold. Days sales outstanding, how long it takes to collect cash from customers after a sale. And days payable outstanding, how long it takes to pay suppliers for inventory or goods. For most consumer products businesses, the bulk of this measurement, and this is measured in days, the bulk of that is this first one, days inventory outstanding. And the way these three are subcomponents of the first one. So let me show you how they're calculated. Most people, days inventory, cash conversion cycle is days inventory outstanding plus days sales outstanding minus days payable outstanding. 60 days or less is considered good. I rarely see 60 days or less in small e-commerce consumer product business. So if you have less than 60 days, one, you're not going to calculate this here. I'll just tell you this right now. It takes some serious brain power to do these. The days inventory outstanding is usually the one that makes it very hard to get to be 60 days or less. And the reason why is as a smaller business, it's very hard to get your inventory sold in 60 days or less. In the case, and I'll show you this in the example, we'll flip to this. This is how it's calculated. I'm not going to go through the calculation because I'd probably mess it up trying to do it live. But essentially, you're taking your cost of goods sold divided by your average inventory over a period. If you're doing it over a year, you would take the total cost of goods sold for a year divided by the average inventory value balance over that same period. And then you times it by 365 to come up with that days inventory outstanding. Now, if you're looking at this like, what? Again, I would go back to the definition. It basically, it's a financial calculation that tells you how long inventory is held before it's sold. Let me just show you this and kind of tell you what it tells me. So I could go into QuickBooks and I'm going to have to pull a bunch of data here. If I was going to do this in QuickBooks, number one, It's going to take a while. But I would probably do, I'd probably run a report that looks like this for my average inventory balance. I would show it by months, and I would basically go and find, and we have not, I don't know why, but we haven't added prepaid and product inventory. I would take the sum of those two things and I would just average them out. But I'd take the balance, the total by every month, and I'd average them out. And then I would go into my profit and loss. I'd run what is my cost of goods sold over that same time period. I would do the math, cost of good divided by the average inventory times 365, and I'd come up with a number. It's not terribly hard, but it is a pain in the butt. Now, what I love about reporting tools is I don't have to do them. I can do that on the fly. I'm actually doing a trailing 12 balance here, and here is my days inventory outstanding. And you'll be like, man, Stephen, your business sucks. Well, it kind of does. It's a small business. It's making less than $1 million a year. I have no leverage. My manufacturer's in Italy, and I have decent terms with them, but we don't have the leverage to be able to say, I'm not going to pay you right away. So we do have some payment terms, or this number would be better. But the time it takes me between starting the order to getting the order is about 4 months. So 4 months of this time, and then I've got to sell that inventory. So you'll see this ramp up as an equation of us ramping up our inventory in preparation for the holiday sales. But this is the biggest challenge that most businesses have, because you're typically manufacturing overseas, takes time to manufacture, takes time to get it from just getting our inventory from Italy to our warehouse is 1 to 2 months. So this is where, for a lot of brands, they struggle until you get bigger, and by bigger, like significantly bigger, to where you can have terms with your manufacturers that are very beneficial to you. And this is how you drive down your days inventory outstanding, is getting better payment terms, where you're like, hey, can you give me 90 days to pay that that inventory, right? So that you're not actually having to actually pay anything. But this is usually what sinks the cash conversion cycle. The other two are less consequential, but I'll talk about them. They're so less consequential in the case of this business that I didn't even build a metric for them, but I can show you those details. The other one is day sales outstanding, and this is really not going to factor into your cash conversion cycle unless you're selling, invoicing people. So if you're doing wholesale or retail, you're invoicing them, how quickly do you get paid? With big channels, your Costco's, your trying to think, I'm just pick your store, Walmart, Targets. If you can actually get your product on a shelf, those numbers can range from 90 days to a lot longer. And so that can really kill you if you're going into wholesale. The only one that benefits you is how slowly do you pay your vendors. This is tricky. This is a double-edged sword. So the slower you are, the better your cash conversion cycle. The ideal, you can actually have a negative cash conversion cycle. And there's some noteworthy examples. In business school, we studied Dell. Another one that I heard about recently is Costco. Costco, I want to say, gets 90-day terms with their suppliers, but they will sell all of their inventory in less than a month. And so what happens is their days payable outstanding is probably pushing 90 days. Their days inventory outstanding is probably like 30. And so what'll happen is they'll get a negative cash conversion cycle. That is the holy grail of business. Now, what does this mean, and what do I do with this? I've kind of told you what it's telling me, but what do I do with this? Well, when I put this into the blender of the cash conversion cycle, and what you see here is that calculation. If I go in to the chart data, Let me show you the raw data. The raw data, I have all of those calculations here. So I have my days sales outstanding. You can see it's really small. We've done a little bit of invoicing, not much. Payables, we have some terms with our supplier. That's offset the days inventory outstanding. So we have structured what we buy our inventory purchases out so that we pay them over time. And that's why you see longer days payable outstanding and it grows. That's a good thing. The longer the payables outstanding, you want that as big as you can without pissing off your vendors or suppliers. But what do I do with this data? Well, this is telling me roughly how long I've got to finance a dollar, either through profits or through lending. So I've got a dollar that's going to be out there in the wind being turned into inventory, being shipped to a warehouse, sitting in that warehouse until it's sold. And this is what I've got to do. I rarely see e-commerce businesses with this below 90 days. If you're doing below 90, I know I said, 30 to 60 is good. That's like, industry best practices. If you get it down to 90, you're doing pretty good. If you get it below 60, I think you're doing really good. If you can get below 0, you are a baller. You should sell your business because this is something that is highly valuable. I mean, it means you don't have to lend very much. You're generating cash before you have to spend it if you have a negative cash conversion cycle. But it's really hard to accomplish without scale. The two examples I give you, Dell and Costco, those are enormous businesses that have spent years and years building up a supply chain that's really efficient. This is also a reflection of how efficient your supply chain is. And so I like to look at it and say, what's it telling me? And you can see, again, it's trending up in correlation with my ramp up for holiday season. But if you can drive this down, you're going to be more cash efficient. So this is a gnarly metric. If you like it, if you like the explanation, or if you like it as much as I do, send me a comment. Okay, other metrics I like that I use situationally. Debt to equity ratio, inventory rate, turnover ratio, return on assets. The first one shows you how much debt a company uses to finance its assets versus equity. The second one shows you the performance of assets that are financed by equity versus debt. Kind of the same thing. Inventory, how many times inventory is sold and replaced over a given period? So the idea is, you want to, the faster that you're selling inventory, the more efficient you are. Return on assets show how efficiently your business is in generating profit. And then there's a whole bunch of other things, many of which are related to some of the ones I've talked to you about. There are different ways of looking at these: accounts receivable turnover, accounts payable turnover, return on equity, so on. But like I said, the ones I really like to look at, I like to look at my quick ratio. How much cash do I have against my liabilities? I like to look at my debt to asset. So how leveraged am I with debt? And I like to look at the cash conversion cycle. And then the others I like, and those are ones that I like to look at constantly. And then the other ones I like to look at occasionally, and depending on the business, depending on a variety of factors. All right. That's a lot of nerding out. Hopefully you've had a chance to digest it. If you have any questions, hit me up. Let's turn our attention to the statement of cash flows. So this is a really good one. If you came to workshop 1, we talked about accrual accounting. And accrual accounting is really good because it actually tells you how profitable you are, how you're actually performing. But you can have profits but not cash. And the question is, where did my cash go? Well, that's where the statement of cash flows comes in. The statement of cash flows is this weird creature. And essentially, it's going to show you the net cash provided by operating activities. So this is the cash generated or used by the core activities of the business, such as selling products or paying for inventory, salaries, rent, and all that stuff. Then you have cash provided by investing activities. This could be cash used for long-term investments, or received from long-term investments. And then you have financing activities. This is usually your debt, or paying back of debt. You then take that and you add those up to come up with your net cash, and then you add your net cash to the beginning cash at the beginning of that period to come up with your cash at the ending of the period. Let's take a look at this. I'm going to go into the first. So again, if you go into your reports and run your statement of cash flows, which is here. So I've got January through August. I'm actually going to go back a little bit further. Let's go back in the time machine to the beginning of September 2023. So I'm going to see a full year's period and how we did. So it usually will start, your net income is an accrual entry. So it's not actually showing you the flow of cash. What it does is it takes your net income and then it makes all these adjustments. and adjustments based on things that are done on an accrual basis. So it'll make adjustments to inventory and accounts receivable and accounts payable and lots of stuff, mostly the things that are on your balance sheet to say, okay, how much cash did I actually generate from my operating activities? And the answer is, well, in this time period, not a whole lot. Oh boy, $800. That's deliberate. We're in a growth mode. Then I look at financing activities, which we didn't have. And I don't, and then I have my, what was the third piece? Drawing a blank. Investing activities. So I don't have those in this particular business because I haven't done a lot of those. And you can see that we had a slight net increase in cash. If you're doing, usually for a lot of businesses, most of the activity is going to happen here in your operations. The others are going to happen as you become bigger and more sophisticated. So the nice thing is here's how I use these in conjunction. Let's say I got my profit and loss statement. I'm just going to do these 1, 2, 3, and I'm going to use a closed period. So let's use August. And I said, all right, I made a net income of $2,100. Yippee. And I'm going to go to, let me just simplify it, same time frame. So I look at that and I'm like, hey, I made $2,100. I am rolling in the dough. But what happened in my balance sheet? So if I were to look at my balance sheet and if I were to look at let's just do a month over month. And what we're going to do is, previous period. Because I just want to compare that. So I say I made $2,100. Actually, let me do one more thing. I'm going to do the dollar change. But I actually increased 10,000. How did that work? And my inventory decreased. So I sold more inventory than I purchased. That probably accounts for some of that. And then if I want to be like, well, what happened from a cash perspective? Let me just go here. Okay, run that report. So I will see the adjustments that were made, right? So decreased a loan balance, increased inventory, increased my credit card balance. And so that's where my net cash from operations applied. So that's how I look at those things. The reality of your financial statements is they're best looked at in conjunction. What questions do you have? Let's open it up to questions. I haven't had a lot of questions. I don't know if I'm melting your minds. The balance sheets are much more complicated than the profit and loss. I think a lot of people understand a profit and loss. What questions do you have around a balance sheet or around a statement of cash flows? And while you're asking questions, we'd also love feedback on the workshop series that we've done. How helpful was it? Um, this is something that we're testing out. I'd also love, Kelly, if you could run the third poll, also love to kind of get a sense of how well your knowledge has progressed. Now, I'm a little concerned because I haven't had a lot of questions. Okay, here's a question. Do you find interest from your client as regards okay. The question is, do you find interest from your client as regard where do you find interest expense? Interest usually is going to show up in on your profit and loss. So where when let me just go into my financial statements and this will bring it together. So where does interest come into play? When I pay when I'm paying back a loan, I'm usually paying back some principal and I'm paying back in some interest. The interest is going to show up as an interest expense on the profit and loss. The principal will decrease the amount that's owed on that loan. So I should see my loan balance decrease, and I should also see that reflected in the statement of cash flows as well. Good question. Um, oh, good question. I don't like that QuickBooks puts inventory in assets. No, I like it. It's the right place. I wish that QuickBooks, I don't mean to confuse you. I don't like that it calls it other current assets. I really wish that they would just pull it out as its own category, which you could do. You could create a custom account under current assets and have it inventory. And actually, we could have done this. I'm just probably ragging on myself, on my partner who set it up this way. So this is just a personal preference. So my partner, the CPA, likes to put inventory under other current assets. Me, the MBA, would prefer to see inventory as just its separate current asset on by itself. But this is something you can choose to do. My guess is QuickBooks encourages you to set it up this way because usually when you go to set up um, new accounts, you have to choose where they're going to be. Okay. Change in long-term liability. This is just the change in principal. The interest is in the net income. Correct. So per the previous conversation, the change in your loan liabilities is going to reflect the decrease of your balance. The expense related to those loans will get reflected in the profit and loss. Oh, and you saw that. So great question. This is the reality is these don't work in isolation. So I've taught you these somewhat separately, but what I'm hoping that you'll understand is that when accounting happens, those transactions can hit one financial statement, they often hit multiple financial, they in reality, they actually are hitting all the financial statements in different ways. Are you able to create a 13-week cash flow forecast with Grow? Ooh, that's a great question, Mark. Let me show you. Short answer is be really hard. I will show you. There are tools out there to create cash flow forecasts. And I regularly look at the tools and try and decide, are they better? I rarely am going to say this. In fact, I usually don't tell my team like quit using spreadsheets, or if I see them doing spreadsheets, quit using spreadsheets. But forecasting, I still really love spreadsheets. And the reason is it gives me a lot of flexibility. There are some great tools out there. They're not cheap. And my issue with forecasting tools is they are so much work that without the same amount of flexibility. And I've worked in Fortune 500s and they still forecast in spreadsheets. So when I'll show you my 13-week statement of cash flows, which I need to roll over. This is what it looks like. It looks very much like my cash flow statement. where I'm taking my cash beginning and then I'm, you know, looking at projecting my cash from operations. And then I go in and I'm layering in what I'm projecting my cash spend to be, and then any sort of financing operations and coming up with my cash balance at the end. Um, it is a fair amount of work to do these. It's super helpful. I am looking at ways to make this more cost affordable. Um, doing a really good, maintaining a good cash flow. And this is a simple business. A more complex business, you're going to have a lot more moving pieces. Um, but this is what my 13-week cash flow looks like. And almost every CFO I've ever worked with also uses spreadsheets. I know there are tools out there, but they're for their price return ratio, I feel like the spreadsheet is still one of the best tools for the 13-week. Live flow. Okay. I have heard good things about live flow. I need to check out live flow again. Thank you for bringing that up. So, live flow is supposed to be a good tool. I need to look at that again and see. I have heard good things about live flow, and I need to see how it compares and see if it's time to invest in live flow. So thank you for that suggestion. Send us your feedback, and obviously, if you would like some follow-up conversations with us, reach out to us here. Happy to talk to you. But otherwise, thank you for attending this 3-part workshop, or this one part if you joined here, and we'll see you on the other side.